Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle, and Happy New Year.
Happy New Year to you and to all the listeners.
Danielle, taking a look at some of the headlines on your blog, Juggling Dynamite. The clean disruption is now underway. There are huge implications for Canada. Denial is not a wise option. What disruption is underway right now?
So it's in the energy and transportation space primarily, but that's impacting all major factors of the economy, and it's likely to continue to accelerate, doing so over the next couple of decades. So even now, between 2020 and 2030, the transition away from the most energy-intensive equipment, vehicles, and just fossil fuels in general is going to really pick up. And it's because of a whole bunch of factors. It's not just all the extreme weather and climate impacts, which are huge everywhere, but it's also just the actual S-curve in technology, which has been taking place over the last decade, certainly. And so we've got, as we've talked before, the influx of things like new emission standards in the transportation industry, whether it's shipping, whether it's airlines, whether it's incentives for more energy efficient equipment. All these things are really coming to bear on global demand. And so it's interesting because, we've got Canada, who there's been several reports recently warning that Canada is in for some very difficult times, not only because of demographics, which is certainly, RBC had a report out this week talking about the fact that, Canada has this aging population, which many of the developed countries do, and we've got immigration has so far been keeping us having some population growth, but the problem is that we haven't had horrible productivity for the past many years, and so we're not getting more efficient or more effective out of the new people that we're bringing in. And there's a lot of concern that we're still in a so-called economic expansion, even though growth has been weak. But the problem is if we get into a more of a downturn, that we would see job losses increase, and that's going to be a very big problem for the economy, for households, for businesses. Already, the investment in plant and equipment by Canadian businesses has dropped to the lowest point since the 1980s, and actually it's gone down 20% over the past 5 years. So it's the worst performance in this metric in 50 years. So it's sort of like, the things that Canada has been, I was saying when the commodities boom was on that we were taking the easy money and riding it out, but not thinking about what came next. And what's coming next is, in fact, already, of course, a major problem in the prairies in Alberta, and where they're in a veritable recession already, where you've got massive problems in the housing market with, people in places like Fort McMurray having their home prices plunge, not being able to find buyers. So this is kind of the leading edge of this wedge in Canada, because we've spent whatever monies we have had in the past decade doubling down on housing, which has become the most, certainly is the largest asset for most people, but it's also typically heavily levered. So there's lots of money owed against it. And you've got this, as I say, this movement, which we're seeing in lots of places, and certainly in the U.S., where boomers are wanting to, raise cash for retirement, figure out a way to lower their expenses, and they're looking to sell their homes and move to either much smaller accommodations or indeed rentals. So rentals are likely to be in demand, and this is going to continue in Canada as well. So we do have pockets of, shortage of supply, which has pushed up pricing again in some areas. But every time price goes up, it really just makes this whole situation worse, because you've got that huge gap now between the people who are trying to sell those properties, take out money for their retirement and their living expenses. There's this huge gulf between them and the price they're hoping to get and the price that the people behind them are willing to pay or able to pay. So it's really, I think we're going to see it spread across much more than just the prairies into many other places. And already we just see such cash-strapped Canadians everywhere that we look. Most of the incomes in households are completely spoken for before received now for things like debt payments and, utilities and just food, basic things like that. So it's a very difficult time. We've got a lot of global think tanks, like the IMF and the World Bank and various institutions have been publishing papers of late on the debt bubble that's really menacing the whole world now. And Canada is really at the leading edge of that, unfortunately.
Well, the Fraser Institute just did a study, and according to them, per capita, government spending now is at a higher level than it was during the middle of the Second World War.
Yeah, exactly, right. And the point is, we know, looking forward, it's quite easy to extrapolate the aging demographic and the fact that, we're going to have to spend more and more on things like healthcare and on things like retirement income supplements and various things, benefit programs, drug programs. So, that's sort of baked into the population that we have. And as I say, the problem is that the money we have been spending in the past, say, 20 years has been to double down on some of the antiquated technologies and sectors which are not going to be the big growth boom in this next 20 years. And so we really have to reinvigorate our whole economy. We've got two major negatives right now. We've got a decline in ICE engine automobiles, and that's happening all over the world, but it's certainly happening in terms of the sector in North America and in Canada, where sales have been falling now for the past 2 years. And, we're seeing already in places like Ontario, plants closing, jobs being lost in that sector. So that's one of the engines that was driving our economy was, these traditional vehicles, which are in a downturn phase. And the second thing was the fuels that drive these traditional engines and vehicles has been the other major area of investment. And you've got people like Mark Carney, formerly of the Bank of Canada, now of the Bank of England, being very vocal in saying, listen, most of those assets are not going to be taken out of the ground. They're just not going to be economically viable in this new climate, which is, with much more intensive taxation on carbon emissions as one part of it. But where the break-even cost for fuel is just going to be, lower and lower over time rather than higher. So it's very interesting. Places like Aramco, Saudi Arabia finally got its Aramco IPO out for a little portion of that company. And what are they doing with the cash they raised? They're doubling down on solar production. So they're looking for companies to build massive solar arrays in Saudi Arabia, and the reason they're doing that is for their own domestic consumption. They want to lower their energy costs at home and become self-sufficient in terms of not using that product, so that their plan is hopefully they want to be able to sell as much as possible of their oil to the rest of the world. But you've got a lot of companies and countries with that objective, right? Because they see this kind of downturn in demand and this shift in this whole transportation sector, and they're desperate to get products sold. So they're doing, it's interesting, a lot of even Canadian energy companies are doing what they can to bring renewable energy in, but typically to lower their own operating costs, right? They're not that dumb. They're figuring out that they can operate a lot of their equipment and properties cheaper on renewable fuels than they can on the fuels they're actually producing. And so they're doing whatever they are in terms of renewables, typically just for their in-house operations, while they're still hoping to sell the traditional products to the rest of the world. So we've got a glut, and there's many international organizations warning about this glut, even with all the trauma you're seeing in Iran and the standoff that went on there this week. You saw a short spike in the price of oil and then a big downturn again quickly, because the reality is that the world is awash in supply. So this is not your typical 1970s style OPEC crisis by any stretch, because we've got so many other sources of fuel, not just of fossil fuels, but of other alternative fuels. So, the good news story is here, there's tons of opportunity coming in things like 5G and things like AI, in things like new transportation modes and new energy modes and new production. There's all sorts of smart things to invest in, but we sure have to do it. And this is where the tricky part comes. When you've got already, massive debt and a slowing economy and a lot of demographic weight, it's very difficult now to also, take funds from short-term consumption and push them out where they need to be in terms of this longer-term investment in plant and equipment and new technologies. But that's our whole future productivity and ability to fund ourselves is going to be very dependent upon the extent to which we do that right now, which means reduce consumption incentives right now in order to save and invest for the future. And if we don't do that, the picture is just going to get darker and darker.
We'll have more with Danielle Park right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, would it be better for Alberta, instead of spending $30 million a year on an oil propaganda office, their so-called war room, how about investing in solar? Alberta's the sunniest province in Canada. Even in the wintertime, when you have focused solar, you can produce power.
Absolutely. And you still get all kinds of rants and crazy sort of pushback on that, but it's a fatal flaw, because the writing is well and truly on the wall. I put on the update from Tony Sebo, who's a futurist who's been, looking at these trends for the last 20 years and just pointing out that, this is not, he's talking about massive disruption within the next 10 years, like starting already now, and peak demand potentially for fossil fuels within the next 3 to 4 years, and then nothing good happening after that. So in terms of demand for that product. So this is why I say denial is not an option. It's a self-destructive choice at this point. And this is going to take, a very serious restructuring of many of our incentives and tax policies. It's probably going to require higher taxation on property owners. I've mentioned this before. There's a ton of people with very little equity of any kind and, struggling to pay their bills. And then there's a bunch of people who have more of the asset-rich part of the economy. And, of course, they don't want to pay more tax. I understand that. I'm one of them. Unfortunately, you can't get blood from a stone. You have to go to where there is an ability to collect funds. And you're seeing this in places like Toronto, for example, where another study has just come up with the reality that Toronto's been under taxing its property owners for the last decade, and now they have massive deficits and problems in, things like affordable childcare, which is essential to productivity of the workforce. They've got lots of problem with, impossible rents, with homelessness, all these things. are just holding back the ability of household formation and progress, basically, in economic momentum going forward. So they're back to square one here and saying we've got so many liabilities, deficits, and funding needs, and we've got not enough capital or income coming in. So there's a lot of pressure right now on the Mayor of Toronto and on the provincial government to increase taxation in things like land transfer tax and property taxes. At the same time, Jim, you've got a huge issue building right now in insurance premiums all over. Now, this is not just in premiums, which are skyrocketing in many areas, but also in deductibles, which are also going up in mind-boggling amounts. So this is a function of consolidation in that industry in the past couple of decades, where a lot of individual underwriters were merged into these larger conglomerates who are now getting hit, for example, from extreme weather claims in one part of the country that's the same company, and they're therefore looking to increase premiums or increase deductibles across the board to try and maintain profitability. You've also got, this is also sort of implicated by the low rate environment where insurance companies have been increasingly stressed in trying to make their typical spread between, buying bonds that match their liabilities, and the amount of interest they're able to collect has been compressed in this low yield environment. So they've got these rising claims from extreme weather and an aging population. They've got depressed income ability or earning ability on the funds that they do hold, and so they're going to respond in the way that they, it's a for-profit model. What they're doing is they're increasing the cost of insurance, and in some cases, there's been stories of townhouses in places in Alberta where the costs have gone up so rapidly that the homeowners are literally going to have to walk away because they just can't afford the premiums anymore on their insurance. And this is something that we're seeing in the condo market also in places like Toronto. So, we've really done a lot of things wrong the past couple of decades. This writing's been on the wall a long time. People didn't want to see it. They wanted to, do a lot of household consumption and gentrification of our principal residence, which is all fine and well, but it's completely non-productive, doesn't produce income, doesn't get more efficient, gets less efficient as the more money pours into shelter. And we're really going to pay the cost here because we've got to increase income somehow in this environment to meet all these capital needs at a time when we've got slowing global growth across the board. And as I say, a lot of the major trends that were sort of paying our bills in the past couple of decades are no longer there.
More with Danielle Park right after the break.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, Harvard Business Review is warning that stock buybacks are dangerous to the economy. Why?
Well, we've been talking about this for quite a while, right? But it's basically this goes back to the incentives in the system are all about short-termism and how do we get an asset price up quickly. And that has been to buy back shares in the past decade. It's been the main go-to of corporations and CEOs who are incented to get the price of shares up quickly. And that's been done at the expense of the strength and stability of the company, because in many cases, not only have they directed all of the cash flow of the company, again, not into innovation and R&D and things that are going to improve their productivity, but rather into things that are going to drive up the price of their shares quickly. And into that flow of corporations buying back shares, you've seen a record amount of CEOs cashing out their own personal holdings. So this is an incredible conflict of interest, but it's been very common. Not only have corporations been spending their cash flow in buying back their shares to boost the price, but at the same time they've borrowed record amounts of debt to also do this, right? So it's not just a function of squandering the cash flow that they were receiving, it's a function of now they've also levered up their balance sheet with the most debt they've had in many decades, just as they're struggling with slowing demand in the world and sort of contracting revenues. So again, this is a cash crunch because people haven't prepared properly for the downturn. We've had this really long extended cycle enabled by all sorts of injections and central bank liquidity, which they're now having to do on a daily basis in the repo market, which is the overnight lending market between banks. Banks are not wanting to lend now to hedge funds and other counterparties because they are doing things like rehypothecating the money that's being lent overnight. So this is leverage on leverage on leverage and sketchy credit. We have, the highest level of junk debt now that we've had for decades in the system, and this is all debt that is likely to have downgrades or not be paid back in full. So again, this is a function of a very long extended cycle where people got complacent with leverage and debt, where central banks enabled and encouraged financial speculation over intelligent investment. And yes, of course, it's driven up the price of the stock market, but it's also under the surface. It's very similar to what happened in the subprime markets in the world in the 2005, 6, 7 era when they were doing a lot of very destructive things with issuing debt without sufficient covenants and protections, and investors were lapping it up without any requirement for protection of their principal or even for, the normal covenants that you'd expect. And so what's happened is that we've got this punch-drunk corporate sector, which is now, starting to default on some of their debts. And you've got a lot of people who have borrowed money on those debts as collateral. So it's a debt on debt Tower of Babel that just starts to decline, fall over. We're seeing a lot of stress in the corporate credit market right now, and I think that's ironic that you've got this stock market rallying in the face of all this, just like we did in 2006-07, where under the surface it was all crumbling. Let's face it, the debt market is much larger than the stock market, and when you get major dislocations in the debt market, it becomes like a massive earthquake that shakes eventually the entire terrain of the financial system. And that's what's basically been happening now for the past several months. So you've got this, as I said, the U.S. Fed has been coming in on an almost daily basis to inject money into the overnight lending market to try and quell and keep that rate that's supposed to be a very low base rate of 1.5% to 2%, and it's been spiking to 6, 7, 10, and not even then. So banks essentially would rather stay on deposit with the Fed at making 1.5% than loan to each other at higher rates, and clearly that's because they've sort of figured out that there's an incredible amount of risk in the principal, and that there's this, as I say, leverage on leverage on leverage in these hedge funds. So it's just a very dangerous terrain, and I think people are going to have to be hurt very badly again, which is very frustrating, right? Because we've already learned all these lessons many times, and most recently a decade ago. This is not like it's only something that happened in the 1970s. This is something that's happened, in the 2000 cycle. It happened in the 2007-8 cycle, and here we are again. And many of the same pet companies that people have been owning in great concentration in funds and ETFs, the so-called blue chip stocks, the Googles, the Microsofts, the Intels and JP Morgan and Apple and all these things that people think are, doesn't matter what you pay for them. They're such big companies that all you have to do is own them. Well, we saw exactly the same mentality, in, as I say, the last two cycles, and indeed in the 73-74 cycle, which was one marked by inflation, but very similar speculative activity and too much debt in the system. And in all three of those cycles, you saw those, most popular, what people thought were the can't lose stocks drop between 50 and 90%. And those franchises, many of them lived to see another cycle, but it didn't mean that the people holding the assets didn't get wiped out first. So it's just, it's really a concoction of all these things that have made risk so high and yet so underpriced today, and that's where the problem is.
Danielle, I know you've given good advice in the past about how individuals can protect themselves in this kind of an environment, but again, for maybe new listeners, what should they be doing?
Well, they have to do a thorough review of their finances now. They have to look at their portfolio with a very objective eye in terms of what meaningful diversification they actually have, because the thing is that many of the debt, preferred shares, corporate bonds, equities that people are presently holding are all highly correlated with one another, and they tend to go up together and down together. So if you're holding a portfolio and you think you've got this sort of diversified smattering of things that your savings are in, the reality is probably all in similar risk profile stuff, which are very vulnerable to significant drops at this point in this cycle. So you really do need to sit down and go through it and have a clear understanding of what you're holding and what kind of a down cycle, downside risk there is to those assets. You also have to make sure that your debt is under control, that you aren't over-levered into real estate as another area of great risk at the moment, and that you have a good amount of cash built up, both in operations and businesses. People that are running their own businesses, they have to be very careful that they're not in a cash crunch situation, that they have a buffer built in, and that shouldn't be just a line of credit, because lines of credit can be called in this environment. Canadian banks are having to take higher loan loss provisions. They're being required right now to bump up what their bad debt reserves are. So all that will impact how much credit they want to have available in the system. So it can be a very sudden shock to everyone who's banking on debt when it starts to rescind and go the other way. So I think it's just, I have people emailing me through the blog frequently, and I'm happy to take a look at what their current scenario is and give them some thoughts. Just another fresh pair of eyes can be very helpful. Unfortunately, many of the eyes that are looking at things today are still on the sell side and product sales side, and they tend to be not as objective as they need to be in terms of the risk management profile of things. So it's important to get someone who's not paid to sell you stuff having a look at this.
I was just going to mention, we see all the ads on television. Go to your local bank and talk to the financial advisors there, but they're really salespeople, aren't they? Not really advisors?
Yes, they really are truly salespeople. They're not registered as fiduciary people who have a professional designation required to actually look at the risk profile. They just have to pick things that are considered suitable, and that's a very scary proposition in this environment.
Danielle, thank you so much for being on the show.
Thanks, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.